All right. Today is Tuesday, June 15th. This is a recap for the stock market activities today. Here we go again. The market is yo-yoing from one side to the other. For about a couple of weeks now, the market has been favoring the deflationary side of the market, the technology, NASDAQ, and high multiple names, on the heels of the bonds market reaction right after the non-farm payroll report. In addition to the CPI report, which showed that inflation is rising by the tune of over 5% year over year. That did not phase the bonds market, and the stock market took a hint of the bonds market reaction and decided to go with the NASDAQ, the high multiple names, and we saw significant scores being made had you followed that trade. But we are now hitting an inflection point, a very important stop, because tomorrow we have the Fed's decision regarding tapering and interest rates. There could be a decision or lack thereof, it doesn't matter. But the Fed's stance on the issue of inflation is becoming extremely important. The market is stuck without further guidance from the Federal Reserve. Let us know whether you're going to taper sooner or later. What is the decision? Because the macroeconomics data speaking loud and clear. Inflation is rising significantly higher, specifically when it comes to prices, but we are seeing economic activities and employment not rising hand in hand with the rise of prices. There is actually a slowdown in economic activities, a slowdown in filling new jobs. And the market today is saying, push the brakes on the NASDAQ, the high multiple trades. It has been good for a few weeks now. Let's book some profits and wait and see. Likewise, you're seeing the inflationary side of the market, industrials, financials, energy catching a bid right before the Fed's decision. Perhaps some minor short covering, as if the market is saying we are not sure at all whether the NASDAQ or the inflationary trade is going to pop higher. Or perhaps the entire market will start to react negatively if the Fed is about to taper sooner than expected. So we look for clues all over the market regarding the expectations of the outcome of the Federal Reserve's decision. Is gold saying anything at all today? Not really. What about the dollar? Not really. The stock market, we're seeing some profit taking in the NASDAQ and some minor bid and short covering in the industrials, financials, and the inflationary stocks. So the stock market not saying conclusively one way or the other what it thinks about the upcoming Fed's decision. Likewise, the bonds market is now stabilizing. The 10-year Treasury yield holding at around 1.5%, not moving significantly higher or lower. Likewise, when it comes to commodities, we're not seeing decisive moves one way or the other. The market in a wait-and-see mode, with exception of copper. Copper did something today, and if we are reading the clue from copper correctly, copper was down big today by the tune of over 4%, and we will cover the price action of copper during the futures market coverage, and we will cover the chart of Freeport-McMoRan during the technical analysis. But for now, why is copper reacting extremely to the downside right before the Fed's decision? In my opinion, copper is saying, wait a minute here. After all of the macroeconomics data that we got, specifically today, Dr. Copper is saying, I believe that the Federal Reserve will announce their intent to start thinking about tapering. And that will be good enough to pop the US dollar higher and therefore copper prices lower. And we will see the correction in copper intensifying. Mind you, this is a reaction to tapering, not to inflation, because inflation is good for copper and bad for the US dollar. But tapering in the meantime is good for the US dollar because it reduces the number of currency in circulation. The cocaine operation starts to taper, pushing dollar prices higher, and copper will react negatively in the meantime. We will see. But this is one clue that we got from copper. Everybody else, the dollar, gold, stock market, bonds market, yields, cryptos, not saying anything at all. No clue whatsoever. So tomorrow will be extremely important. But what triggered the move in copper and the sudden profit taking in the NASDAQ trade and perhaps bidding the inflationary trade just by a tiny bit? Well, in the morning, we got the Empire State Manufacturing Index, and the headline number slipped slightly, meaning that the economic activities in the Empire State Empire State is down slightly. But here's the catch. Prices paid remained at elevated levels, and the time for delivery has reached a record, the longest on record. What does that mean? Perhaps we're heading into stagflation, where prices continue to stick higher. We see delays all over the supply chain, shortages, but the economic activities start to slow down. Look no further than the housing market. The demand for houses has dropped significantly, but prices remain at elevated levels. And this is a phenomenon when prices go out of whack and stay at extreme elevated levels. It prices out consumers out of the market. But in the case of prices paid for the Empire State Manufacturing Index, it is pricing out manufacturers and prompt them to slow down economic production and economic activities in hope of better prices in the future. These are classic signs for a phenomena that we're not allowed to say here. Gotta be careful. Last time we said it, the channel got banned. But these are classic signs for stagflation. Furthermore, and here's the big one that leaves no doubt whatsoever that inflation is surging significantly higher to the point where it's actually going to slow down the economy. So watch out here. The PPI, the Producer Price Index, we got the biggest jump on record, the highest reading in history. The PPI is up over 6% year over year. You cannot ignore the problem anymore. You cannot say, oh, where is inflation? Is it over here? Is it over there? You cannot deny anymore. Inflation is here, and it is rising significantly higher, and therefore the Federal Reserve will not be able to bullshit their way out of this one. They have to acknowledge that inflation, as they want it, by the way, is rising significantly higher. The problem is, and the dilemma that the Federal Reserve has to go through right now, should we let inflation continue to surge higher, meaning if we allow inflation to go a little hotter than right now, which is already hot, will the economy be able to recover more jobs and resume economic activity? If that is the case, then we are willing to tolerate higher inflation rates. But if, from the evidence we got so far, inflation rising higher significantly, but jobs creation and economic activities are actually starting to plateau and slow down. If that is the case, then the Federal Reserve has to understand that if they continue to push the pedal to the metal, leave the cocaine operation on high gear, what will happen is that the economy will shift into stagflation. And that's not going to be very good for the economy or for the Federal Reserve. So tomorrow will be extremely important for the Fed to let us know just a little bit of transparency. Let us know what you're thinking about these numbers. CPI reading of over 5% year over year, and the PPI is over 6% year over year. You cannot ignore the problem anymore. You gotta understand this. This is a needle that has to be threaded extremely carefully, because this so-called economic recovery is unlike anything we have seen before. We saw a flash crash, a flash depression right after the COVID-19 crisis, and then came the Fed to the rescue with a tsunami of liquidity. Well, we found out that the Fed has overdone the tsunami of liquidity, and now we have consumers, corporations, flush with cash. We have a massive pent-up demand in the economy, pushing used car prices higher, pushing housing prices higher, pushing commodities prices higher. And you have two phenomenons happening at the same time: higher inflation and also higher unemployment, which is contrary to the Phillips curve. The Phillips curve states that as the unemployment rate starts to go down, inflation rises higher. And there was always the chicken or the egg debate. Do low unemployment rates push inflation higher, or is it inflation going higher that leads to a recovery in jobs? This is at least what the Federal Reserve is thinking. But what if I told you that we are in unique economic conditions, and everything you learned in your economics classes has to be thrown out of the window? What if inflation and unemployment are independent factors? Is anyone at the Federal Reserve raising that point? What if we are wrong about inflation and its association with unemployment? What if these are independent factors and our policy is misguided? Do we even have that kind of independence over at the Federal Reserve? Or are they just a bunch of zombies going with the playbook? The argument from those concerned about inflation is the Federal Reserve will have to start tapering now. There are two ways the Federal Reserve will approach tapering. Either they're going to do it right now and they start to release their foot off the pedal gradually, little by little, perhaps tapering some MBS purchases. Not a lot, but maybe $10 to $20 billion a month. That will be a soft tapering. And in my opinion, the market will be more receptive to this approach than the next one, which is harsh tapering. This will happen if the Fed decides to say, well, yeah, inflation is rising higher, but there's nothing to see here because it will be transitory. And even if it is not transitory, we got the tools, bro. If they say that, then inflation has the green light to continue to rise significantly higher. And at some point, when the problem gets out of hand, the Fed will have to slam their foot on the brake, and that will be a harsh tapering. The market will not be so receptive to this approach. And by the way, what is your assumption? Let's say the Federal Reserve comes out tomorrow and says, you know what? We're not going to taper right now. We're not thinking about anything. And the CPI, PPI numbers, yeah, that's expected. This is transitory, yada, yada, yada. The consensus is that will be a green light for the NASDAQ, the high multiple names, the deflationary stocks to pop higher. But be careful here of what your assumptions are, because we have people like Paul Tudor Jones, who did an interview with CNBC yesterday, and he says, if the Fed decides to say that we're not thinking about tapering, he will go all in the inflationary trade. And this is where it really gets interesting. You think you know what the outcome is in terms of the market's reaction, but be careful because the market might react in the opposite direction. It all depends on the market's interpretation regarding the Fed's decision or lack thereof. For now, we have copper saying, watch out. They're going to start talking about tapering. And if that happens, the dollar pops higher and copper, will start to go lower. So even if the opposite happens, where the Fed comes out tomorrow and says, you know what? We're going to start thinking about tapering. What is the assumption, the consensus that you and I have? Well, we will see names like Freeport, Alcoa, the financial names, industrials, the inflationary trade surging significantly higher. We will see the NASDAQ, the mania names, the high multiple stocks declining significantly. But be careful here because the market might interpret that in a totally different way. The market might take it as, okay, they're going to start tapering. That means that the party's over. Inflation will start to recede. Interest rates will start to rise higher. Therefore, we're just going to fade everything. The inflationary trade and the NASDAQ maybe rallying banks on the heels of higher interest rates. But that's about it. But even the bid for banks is not guaranteed because what if the market says that, wait a minute, the tapering is going to happen sooner and this is not going to be good for the economy. They're slowing down the economic recovery and we see yields going down. Even though the Fed is tapering, that could be a reaction too. I'm not trying to confuse you here. I'm just trying to lay out all the possible reactions for the stock market, regardless of the decision. You and I have a consensus of what the market might do, but expect the unexpected. And now that I made you scared, shitting your pants already, let's move on and cover the market's performance today. And here we go. The Dow Industrial Average closing in the red, down 93.96 points, or a decline of 0.27%. The Nasdaq down 101.29 points, or a decline of 0.71%. The S&P 500 down by 8.34 points, or a decline of 0.20%. Moving on to the sector's performance. Leading the pack at number 1 by far and capturing the gold medal, energy. At number 2 for the silver, financials. At number 3 for the bronze, industrials. You're seeing that this is the complete 180 of yesterday. The inflationary sectors of the market are outperforming today. Meanwhile, the laggards of the day led by the winners of the last few weeks, real estate, technology, and communication services. What about the advanced decline ratio? The NYSE 49% advancing versus 48% declining. The Nasdaq 35% advancing versus 62% declining. Remember, the breadth for the Nasdaq was unhealthy even when the Nasdaq was leading the market higher. Moving on to futures, we have crude oil prices rising higher again, both the WTI and Brent trading comfortably above the 70 level. The reaction of crude is extremely important tomorrow. The assumption is if the Fed hints at upcoming tapering, then oil prices will dive lower. If the Fed lets inflation go, it's not high enough to our taste, we want to see more, then the assumption is crude oil prices will rise higher. What about softs? Lumber rebounding higher just slightly here, and this is the weekly chart for lumber. A massive drop from the highs. And the Fed's apologists, inflation deniers, the transitory camp, are already having a massive orgasm. Oh, you see, it's transitory. It's over. Lumber prices are down 30, 40, 50%. But what they're not telling you is that lumber prices are still highly elevated. We need another 50% haircut for housing prices to start to cool down once again. But watch out here because we talked about the demand, the aggregate demand. If prices go down and the stock market is still trading higher and the consumer is still confident, they're waiting, they're holding their cash and waiting for better prices, well, guess what? If better prices arrive, they will stampede again and buy houses, pushing prices to rebound higher all over again. Inflation is a monetary phenomena. If the Fed continues to print, the stock market will continue to rise higher. If the stock market continues to rise higher, then that will elevate real estate prices. It will elevate consumer confidence to spend like a drunken sailor. If the Fed starts to taper, crashing the stock market, that will be the ultimate deflationary move, because it shakes off that confidence in the market where consumers are willing to overbid and overpay for houses because they're confident when they look at their retirement portfolios and their stock portfolios. They're trading at all-time highs. I got a few $100,000 in the bank, in my trading account or my retirement account. What do I care? I feel confident. Stocks only go up, so why not overbid and overpay for these houses? Unless the Fed starts to taper tomorrow, specifically MBS purchases, I believe that lumber will rebound higher. On the other hand, if the Fed comes out and says, wait, we're going to start to taper MBS purchases, then I believe that lumber prices will continue to slide lower. But that doesn't mean that the demand for housing will all of a sudden go away. It is an equilibrium formula. Would you like to overpay for the house and enjoy a low mortgage rate? Or would you like to not overpay for the house, but pay a little more in your mortgage? It's a no-brainer. I'd rather pay more in my mortgage than financing a house that is overpriced. But let's be honest here. Do you think that the average Joe and Jane in this country are financially savvy enough to understand this? Of course not. Back to softs futures. We also saw gains for cotton. Meanwhile, we're still seeing declines for sugar, coffee, OJ, and now coca futures. What about metals? Gold is playing poker once again, not saying anything at all. Meanwhile, silver, platinum are down by about 1% apiece. Palladium futures are trading slightly higher. But here is the headline. Copper futures are down significantly by over 4%. Should we trust the reaction of copper today, predicting tapering, or is copper being dramatic and overreacting? You will see. What about meats? Gains across the board, led by live and feeder cattle. Meanwhile, we saw modest gains for lean hogs futures. The prices of meat, absolutely insane. Do me a favor and go to Costco or any store you want. The prices of meat, absolutely insane. You cannot not notice the increase in inflation in meat's prices. It's the most obvious inflation you can see right away when you visit the grocery store. What about grains? Corn trading at 666, the devil, and it is the only grains futures trading higher. Meanwhile, we saw declines across the board. More pain for wheat, rough rice, oats, canola, all declining by more than 1%. Meanwhile, we saw modest declines for soybeans, soybean meal, and soybean oil futures. Moving on to the big casino, the options market. We have a lot of activities in the casino today, specifically when it comes to unusual trades. But let's start with the volume leaders. At number one, here comes the apes once again, and you got to commend them here because it is impressive that they kept the options volume elevated so far. It has been about 3 weeks since the mania started, and they continue to stampede to buy call options. And this is keeping AMC prices elevated. The moment they cease buying call options, that's when the mania stops. Anyhow, for now, AMC at number 1 with about 1.3 million contracts. About 68% of those were calls. The number 2, Apple with about 1 million contracts. Lots of call options buying for the big Apple. About 71% of the options volume for Apple was call options buying. What about Tesla, the souffle, at number 3 with about 650,000 contracts? Watch out here, only 43.5% of those were calls. We're seeing more bearish bets against Tesla. We also saw elevated activities for DraftKings, the ticker DKNG. Now, one of you contacted me today and said, you respect Hindenburg, the short seller, but you also like DraftKings. And Hindenburg is now attacking DraftKings. So what do you say? Are you in Team Hindenburg or are you in Team DraftKings? Here's what I say. Neither. I'm just grabbing the popcorn and watching the show. Hindenburg, from my understanding, are not shorting DraftKings. So they have no interest, no financial ties in the research. So you gotta give them the benefit of the doubt here. I do like DraftKings as a company and as a concept that represents online gambling in the stock market. But if they are committing any wrongdoing, then that's their problem. Moving on to the unusual activities that took place in the casino today. Everybody's anticipating the Fed's decision. Why not hedge ahead of the decision? Perhaps it comes out as tapering and we see the market crashing, and here comes the insurance bets. Starting with the triple Qs, the NASDAQ. They're buying the 319 puts, expiration date July 30th. With expectations that the NASDAQ will drop over 7% by then, they paid about $3 a piece to enter this trade. All in all, bringing the total to about $7.5 million. This is a big hedge fund, a big institutional investor, hedging against their current positions, or perhaps betting against the NASDAQ. Here's another bet against the market. In this case, for the SPY, they're buying the 395 puts, expiration date July 30th. This is perhaps the same trader, by the way, because they're picking the same expiration date. They're expecting the SPY to drop by about 7% or more, and they paid about $2.65 a piece to enter this trade. All in all, spending about $3 million for this trade alone. What about the trade at the bottom of the table for the ticker SLCA? This is a silica producer, and the stock surged higher today. We have somebody betting for more upside. Whether this is going to be the next meme stock, Wall Street bets, who knows? They're making a bet here by buying the $13 calls, expiration date July 16th, with expectations that the name will rise by over 11.5% by then. They paid about 70 cents a piece to enter this trade. All in all, bringing the total to about $500,000. Continuing with interesting trades, what about the ticker TSLA, the souffle? They're buying a lot of calls here. The 740 expiration date July 30th, with expectations that the souffle will rise by over 23.5% by then, and they paid about $8 a piece to enter this trade. All in all, bringing the total to about $5.8 million. What about the ticker GME? This is a short-term one because the expiration date is this Friday, June 18th. They're buying the 195 puts, expiration date, well, we just talked about it, June 18th. And they're expecting GME, GameStop, to drop by more than 12% by then. They paid about $3 a piece to enter this trade. All in all, bringing the total to about $1.8 million. Notice that GME GameStop has been underperforming AMC, and the reason is the AMC crowd is committed. They continue to buy call options, unlike the GME crowd. Perhaps the price for GameStop trading above $200, that makes call options more expensive than AMC. Moving on to Facebook. The ticker FB, they're buying the 365 calls, expiration date August 20th, with expectations that the name will rise by over 8% by then, and they paid about $6.65 a piece to enter this trade. All in all, bringing the total to about $2.6 million. What about the trade for the ticker XOP? This is the Energy Oil ETF. This is an interesting one, by the way, because they're making a bearish bet This is a contrarian bet because the market has been rallying the energy sector even though the inflationary trade has been fading away. So somebody's betting against the flow. They're buying the 92 puts expiration date July 16th with expectations that the name will drop by over 6% by then. They paid about $2.15 a piece to enter this trade. All in all, bringing the total to about $860,000. What about the trade for the ticker AA, Alcoa, another classic inflationary name? They're making a bullish bet here by buying the 38.5 calls, expiration date July 2nd, with expectations that the name will rise by the tune of over 6% by then, and they paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $300,000. Lastly, at the bottom of the table, this is another meme stock, the ticker CLOV, Clover. They're making a bearish bet by buying the 12 bucks puts, expiration date July 9th, with expectations that the name will drop by over 13% by then. They paid about $1.35 a piece to enter this trade. All in all, bringing the total to about $400,000. Lots of interesting trades going on in the casino today. Moving on to the heat map analysis. Right away, you're seeing the 180 picture of yesterday. The yo-yo game, back and forth, back and forth. We're gonna ride the inflationary stocks for a little while, then dump them and ride the NASDAQ instead, back and forth, back and forth. But the predominant theme for the year has been the inflationary trade. And today we're back at appreciating the inflationary stocks once again. Not by much, but slightly outperforming. You have financials, industrials, energy outperforming, materials. It's more mixed because of the reaction of copper. Copper is reacting negatively to the upcoming Federal Reserve's decision. On the other hand, the disinflationary side of the market, technology, communication services, and certain consumer cyclical names, are actually trading down. Massive losses for the software names, Tesla, video game stocks, Activision, Take-Two, with big declines today. And therefore, I kept saying over and over again during this mini rotation of the rotation from inflationary stocks back into the NASDAQ. Be careful here. Don't make any major decisions. Stick to the trade you're currently in. If you are in the inflation stocks side, stick with these names. Hedge your portfolio, buy puts, sell puts, take some profits off the table, but don't hop all together from the inflationary side back to the NASDAQ. Participate via call options buying only until we get more clarity from the Federal Reserve and, most importantly, the market's reaction of the decision. What about the themes analysis, starting with the reopening trade? Mixed picture here, mostly in the negative side. The market is not interested right now in picking any theme. We're seeing meme stocks catching a bit. Seems like traders and investors are now more interested in meme stocks. The majority of messages I get right now these days are about meme stocks. What do you think of this? What do you think of that? Bro, why are you so negative on AMC? Join the apes. We'll give you free bananas. No thanks. I'm just watching the show right now. What about the inflationary stocks? Mostly trading in the green, but we saw some losses, not significant ones. The market is still not sure about the next move. But the most important move here is Freeport-McMoRan, down by about 5% today, along with the prices of copper, as I explained to you during the futures coverage. Is Freeport the leading indicator? And even if it is the leading indicator, what is it actually saying? Is it saying that the dollar will pop higher and therefore copper prices will go down, or is it trying to transmit a broader message that the inflationary trade is perhaps over? Because once the Fed starts to taper, that will tame inflation expectations than before. We will see. Very confusing. I understand. I get it. And therefore, stick with what you got until you get more clarity. It's not my fault. It's Papa Jerome's fault. He's not being clear. He's hiding and swarming around, trying to be vague, and he thinks that's cool, by the way. Oh, he's such a mysterious guy. We can't read him. Moving on to the disinflationary stocks, mostly a negative picture in anticipation of the the decision from Papa Jerome, and they're taking some profits here. Not an indicator one way or the other about how these stocks will react tomorrow. We don't know. We don't know anything at all. Even if I tell you that the Federal Reserve will not taper, they're going to do the same thing. We're not thinking about thinking. How can you guarantee to me that that will rally the NASDAQ and the high multiple names and not do the opposite, where the inflationary stocks actually start to rise higher? We got to wait for the market's interpretation of the move. Moving on to charts, starting with AMC. We're back. Why are we back? Because you guys complained. First, You accuse me of being too focused on the meme stock mania. What are you doing? You're talking about AMC all day long. Stop it, etc., etc. Okay, we stopped it. Now we're getting complaints from the other side. What are you afraid of the apes, bro? What's wrong with you? Start covering AMC. We want to know. Okay, I can do that too. I got no problems at all. We had the triangle consolidation that was broken to the downside. And we saw losses of about 25% or more. Then we saw a rebound right at the price level of 40. Do you think that that was a coincidence? Think again. That was the number with the highest open interest of puts as the stock started to trade down. Now, when market makers sell puts and these puts start to become in the money, what happens? The market maker has to buy back the stock. And therefore, you saw the reaction at the price level of 40. Now you're seeing the opposite on the upside. The calls with the highest open interest happen to be at the 60 levels. What happens when the market maker who bought the stock at 40 is now looking at the screen and it is reading 61, 62, meaning that the $60 calls that they sold as covered calls are now in the money. They have to sell the stock. They bought at 40 and they're dumping at 60. They're making a nice profit here, but it's all about the options market. This is a gamma squeeze, a classic one, dictated and guided by the options market. Now we have the resistance at around 60, and we're seeing higher highs and higher lows. So long as this pattern continues and we see a higher high tomorrow, then the rally goes on. However, what the apes don't want to see is the following. What if this is a head and shoulder formation, topping at the level of 60? That will mean that we will see declines starting tomorrow for AMC. Watch out the open interest for the name, and you can trade the stock perfectly, buying when you need to buy and getting out when you need to get out. Moving on, back to the human market, the SPY 30 minutes chart. Yesterday, we said that the sky is the limit for the SPY. We have to wait for the chart to show us the next resistance level. For now, the chart decided that 425.45, you can round this number to 425.5, but that is the resistance for now. It's only based on 1 day worth of reactions, but this is what the market is marking right now as the resistance level. We saw a big reversal right at 425.45. Does that mean that the bears are gaining advantage when it comes to the SPY? Not at all. The support level of 423 is not broken yet. Once you break that level, then the bears start to gain advantage. And here is another perspective from the futures chart. This is a 45 minutes chart. The chart has been knocking over and over and over again at the very important resistance level of 4,232. It finally managed to close above that level, and now it is catching support from this particular level. It acted as strong resistance. The assumption is that this level will do the same as support, acting as a floor for the SPY. If the chart breaks that level again, it's not the end of the world because it goes back to the consolidation range. It's not a bullish signal, of course, but it is not a bearish signal either. The bearish signal starts when the S&P 500 futures break 4,212.5. What about the Nasdaq? Again, we said that the sky is the limit. We have to wait for the chart to show us where the resistance level is. The chart decided that 344.5 is the resistance level. So we're going to play with that number. The support, 340. The resistance, 344.5. If the chart breaks the range, that will trigger a trade. For example, breaking 340, the support level will ignite a short trade for the Nasdaq. Likewise, breaking 344.5, trading above that level will ignite a call options trade for the name. And here is a daily chart for the futures contract for the Nasdaq. We talked about 14,000, a very important number, a very sacred number for the chart to respect and spend an adequate amount of time consolidating around this number. You cannot just blast above this number, 14,000, and rally to the moon without giving it the respect it deserves. It's an important number where the chart got rejected twice before, and the assumption is, yes, third time could be a charm, but it's not going to be easy. Moving on to the IWM 30 minutes chart. We talked about the gap and crap yesterday, and so far that's holding. The IWM is underperforming. You're seeing the meme stocks starting to cool off. You're starting to see the reopening trade, not so hot so anymore. The airlines, the cruises, hotels, casinos. Investors want to see more data. Does it really make sense for MGM and Marriott to be trading above pre-pandemic highs? Maybe, but show me the results. For now, maybe we should cool it off with betting these names higher because they're not out of the woods yet. What about the RUT, the Russell 2000 daily chart? The bulls still have the advantage and the momentum is still positive. But looking under the hood, the 30 minutes chart, we're starting to see signs of trouble. This is the beauty of contrasting the short-term outlook, the 30 minutes chart, versus the big picture, the daily chart. The daily chart is still supreme, but the shorter-term charts, in this case the 30 minutes, is what's under the hood, working as a leading indicator. What about the Dixie, the dollar index? Not doing a lot today, but we already saw a saucer bottoming formation. The US dollar is trading above 90. The momentum indicators are positive. All of what the dollar is waiting for is for Papa Jerome to come out tomorrow and says, you know what? Yeah, I am thinking about thinking. And then the dollar blasts higher, closing above 91, maybe all the way to 92. We will see. But if the dollar pops higher significantly, that will translate into a lot of pain for metals. Speaking of, here is gold, still holding 1,850. But tomorrow is a decisive day for gold. If the Fed says we're going to start tapering, you got to watch out for the reaction of gold. We talked about the potential of confusion, even if the stock market reacts one way or the other. Let's say I have a wiretap on Papa Jerome's phone, and I know for a fact that he's going to come out tomorrow and say, hey, I'm going to start thinking about tapering. Can I guarantee that the stock market will rally the inflationary stocks or the NASDAQ? Not really, I cannot guarantee that. But I want to watch how gold reacts, because I believe that the reaction of gold will be the one to follow. Whatever gold does, the market will follow. That is at least my opinion. The chart of gold is becoming the most important chart to watch in the entire market. What about yields? Crawling back to 1.5%. It is still way down. The assumption is if the Fed starts to taper or announce tapering, then we will see yields popping higher significantly. But there is an alternative scenario. We talked about it already, and that depends on the market's interpretation of the tapering. If the market believes that it's too early, let inflation go a little bit. Don't stop the party. If the market thinks this way, then maybe yields will actually go down, indicating that the economic recovery will start to slow down. The Fed is tapering too soon. It is possible, not likely, but possible, that this reaction will take place tomorrow. And once again, I hate to be redundant, but this is important to mention. Let's say the Fed says we're not tapering. We're going to wait and see for more data to come out. Okay, what is the assumption here? Yields will drop lower because the tapering is not going to happen. We're going to see bonds rallying higher, pushing yields lower. That is the assumption. But what if the market reads it in a different way and says, hey, if the Fed doesn't taper now, inflation will get out of hand, so let's rally yields higher. Are you paying attention or not? This is the difference between these zombie channels. All over YouTube, looks at the chart, oh, he's a line here, he's a line there. Not in this channel, baby. We play the game differently. We think out of the box. Moving on to the VIX. This is a 3 hours chart. I'm trying to illustrate something for you. We have a downward slope that acted as a resistance, pushing the VIX downward. The VIX is now bottoming and stabilizing. And the question is it about to reverse the trend from negative to positive? For now, we're not seeing that yet. All of what we're seeing is the VIX is out of the negative consolidation, the negative downward trend. My threshold is the level of 20. If the VIX manages to close above 20 by the end of the week, then we have a positive trend under construction. Moving on to Apple, what's going on here? Still looking good, consolidating in a bull flag formation. The assumption is that Apple will be able eventually to crack above 131. That is the assumption, but of course, if the NASDAQ throws a fit tomorrow, then Apple will go down as well. What about Tesla, the souffle? Not looking so good today. It is facing that 629 level, and that is proven to be an extreme resistance level. Very strong, very hard to crack above. You need to push that ludicrous mode before you're able to crack above 629. Bitcoin is rallying higher. Reverend Elon says he dumped about 10% of his position, but he still have about 90%, assuming that he is telling the truth, by the way. And if Bitcoin rallies higher, then the souffle should be able to go higher. But the souffle is tied to another trade, which is the inflationary trade, in the opposite direction, of course. Meaning if yields continue to rise higher, and we are expecting more inflation, Tesla goes down. But if we're not worried about inflation and yields go down, then Tesla starts to go higher because it is a high multiple name, valued based on future earnings. The present value future earnings appreciates under low interest rates. For the technicals per se, you got 629, this is the resistance, and then you got 540, that is the support. Breaking either way, at the weekly closing, will trigger a trade. For now, it's purgatory. The souffle is not going anywhere. It is consolidating within a specific range. As a trader, there is no opportunity here. You cannot trade this. There is no money. The volatility is way down. You gotta wait for the crack one way or the other, 629 or 540, and trade it that way. What about tulips? Bitcoin closing above 40,000. That is an important milestone for the cryptomaniacs. But the most important one is 42,000. Cracking above this level will ignite a rally in BTC, assuming that it will be able to retest and keep 42,000 as support. Perhaps drunk Michael Saylor needs to up his purchases of Bitcoin because whatever he's done is not enough. He bought a lot, issued a lot of bonds, used the money to buy Bitcoin. It's the greatest gamble of all time. Either this guy will be proven to be the smartest guy in the world or the dumbest dipshit in the world. And from history, knowing what he has done in the dot-com bubble, yeah, I'm not betting with this guy. I'm betting against him. And here are bonus charts for you. You wanted tickers? Here are tickers. Right in your face. How about we start with an inflationary name, a classic one, Deere. Pretty much straight line to the upside. Everybody who bet against this stock since last year lost money. The trade has become overcrowded and overloved, and now we're starting to see a correction in Deere. But it is keeping highly elevated Fibonacci retracement levels. Was that enough? Did the market take some air out of the Deere bubble? Are we going to see these inflationary names catching a bid once again? Perhaps. But even if the stock goes down to 288.5, the stock is still way up since the beginning of the year. So all of these Cathie Wood types, the transitory team saying that watch out, the inflationary trade is over, commodities are going to go down, Deere will crash, Caterpillar is over, Alcoa is done. What are you talking about? These stocks are up double digits, if not triple digits, since the bottom. They're correcting naturally, just like the correction we saw with the NASDAQ. There is nothing wrong of taking some air out of an overcrowded trade. But the macroeconomics and the monetary policy so far are supportive for these stocks to continue to rally higher. For me, the number is 288.5. If the stock breaks that level from a weekly perspective, then we have something different entirely. And perhaps Deere will fall out of favor. But so long as the chart holds 288.5, I see the chart holding these levels for a longer time. Here's another one, FCX, Freeport-McMoRan. Straight line to the upside, and last year, I've been saying over and over and over again, buy copper, buy Freeport-McMoRan. I bought it at $10. Back then, nobody wanted to buy the name. Copper, what are you, crazy? Stick to the technology, bro. Well, technology has been pretty much doing nothing since September of last year. Meanwhile, this inflationary name is up about 1,000% from the bottom. Now, all of a sudden, we have the inflation deniers, the Fed's apologists, saying, you see, copper is down, Freeport-McMoRan is down, inflation is over. It was all transitory. Okay, for me, the technicals, 36.30, that is an important level to keep for Freeport. And then we have my number, 30. If the chart breaks 30, then we have a total different game here. And I will start to exit the position. For now, I'm not doing anything at all. If anything, I just have some put options as insurance. And these put options appreciate as the stock goes down. So you lose some of your stock value, but your put options are appreciating and compensating you for the losses in the stock price, perhaps even making you money. And this is a classic way to use put options as insurance. Here's another name, a different one. This is not an inflationary name. This is a big cap technology name. And it's a Dow Classic now. CRM, Salesforce. Since the inclusion of the Dow, and I don't know why people buy the stock on the Dow inclusion optimism. That is a death sentence for a stock. Joining the Dow is not a good thing, by the way. But we saw that consolidation. We saw a channel, a downward trending channel for weeks and weeks and weeks. And now this channel is being broken to the upside. So does that mean that CRM will go back in favor once again? From a technical perspective, yes. From a valuation perspective, perhaps. It is not the most absurd valuation at all in the stock market right now. In fact, it is actually kind of reasonable. But the problem is that the stock is tied up with the NASDAQ and the technology and software names. If these names react negatively to tapering, then the assumption is that Salesforce will crash too, until and unless the market starts to distinguish between mania names in the tech sector with high valuations, out of whack valuations, we have a lot of examples, the CrowdStrikes, the DocuSigns, etc. Will the market be able to distinguish and say, wait a minute, Salesforce is kind of a value name, considering its growth. Likewise, Facebook. It's not absurdly overvalued. Matter of fact, it is a value name within the tech sector. When will the market distinguish between different names in the tech sector? I don't know. But when the market does that, CRM will be one of the names that I will consider buying. A safe strategy to get involved in the stock right now is buying call options. And if the stock trades above that level by, say, your expiration date, doesn't matter what it is, August, September, October, whatever expiration date you pick, whatever strike price you pick, the stock closes above that level, you can exercise your option and buy the stock. Lastly, what about the ticker AVO? You like avocados? If you do, you're going to like the stock because we have an extreme drought going on in the western United States, specifically in the state of California, the largest avocado producer in the United States, meaning that California avocados will cost you more. But I know what you're going to say. What about the Mexican avocado? That's a lot cheaper. Not really, because the drought is also taking place in Mexico. So the prices of avocados are rising higher significantly, and this stock is rallying along with the prices of avocados until and unless the millennials and Gen Zers stop eating avocados. And I don't see that happening anytime soon. Avocados, the future, bro. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Just in case you weren't paying attention this whole video, we have the Federal Reserve's decision. Jerome will speak and the market will react. And usually the market has a knee-jerk reaction right after Jerome speaks. So what is the strategy for tomorrow? Nothing. Grab a big bag of popcorn and watch the show. However, the smarty pants like us, you and I, once the market closes, we're going to start to comb through. Let's see how gold reacted. Let's see how copper reacted. Let's see how stocks, bonds, and different assets reacted to the decision or lack thereof. And we'll take it from there. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.